Sold at 560.
785 the first, 785 the second, be sure, 785 the third, and final time, sold. The third and final time at £910,000, sold. Welcome to the latest edition of the Allsop Propchat. My name's George Walker. I'm joined today with my colleague and fellow auctioneer, Richard Adamson, to look at the auction market, how it was and how it will be in 2025. And today also, we're welcoming Susannah Summers, a partner in our commercial valuation team. Susie, hi, this is your first or second podcast?
Second podcast ever, yes.
Really?
Yes.
And how long have you been part of the team?
16 years, yes,
Really?
16 years at Allsop, so yeah.
Good.
Must
And
be
that
doing
your
something
team
right.
is what, 20, 30 people?
25, based in London, Leeds and Scotland. So we're growing slightly, growing a bit in Leeds this year, growing a bit in London this year. So
Bit of Manchester coming up?
Bit of Manchester coming up, bit of crossover over there, which is very exciting.
Okay, and interestingly, the valuation aspect also is one of the bigger, faster growth things over the last 5 years, isn't it?
It is, yeah, it is. Yeah. We've seen year-on-year growth in what we value. This year to date, we valued nearly £2 billion worth of property just on the commercial side.
Okay.
So for a relatively small team, we're a busy team.
And you always seem so frantically busy. Brilliant. But the
We
biscuits are good up your end. So look, what we're going to cover today, Richard and I, obviously, I'm on the commercial side. Richard runs the residential auctions. We will cover that, and Susie will interject really who they're valuing for, why they're valuing, what different lenders there are. We're going to say how we would invest £10 million for growth in the next 12 months. So hopefully you'll stay and listen to that, because we've all got very different ideas, commercial resi and very much more ethereal commercial from Susannah Summers. So good. Richard, auctions has been £1 billion the first time since 2016. £1 billion between us, 3,000 lots plus. That's a lot.
You've taken all my notes away now. That's it.
Absolutely right.
Absolutely right. £1 billion in 2024 raised, which, as you say, is the first time in almost 8 years since that last happened, which is extraordinary. And in terms of number of lots, I mean, over 3,000 lots. Somebody in my office was looking into it, and I think it works out on working days like 8 deals. It's an extraordinary amount of deals that happen.
Hang on, that just resi deals?
No, across the
Auction
business.
deals. 8 deals a day?
Something like that, yeah.
Wow. How many in the team? It's quite a lot of people down there.
We're 24. We sold over 2,500 lots last year. And the year before that, which was a hugely successful year, we sold 1,600. It's been quite a year.
So lot sizes, I've seen flats in Mayfair down to flats in Huddersfield. I mean, has the average lot size changed much?
Do you know what? It hasn't. I was looking at it this morning, and it hasn't. Our average lot size, based on those numbers, you can easily work it out, is 240,000. I'm going to state the obvious here. That's probably come down a bit because we've sold an awful lot of volume in some of the regions where that value is lower than 200 or lower than 250. It's brought that average down. But actually, we've still sold an awful lot of high-value properties. It's been watered down in terms of that particular statistic because of the lower value stuff and huge volumes of it.
This is one big seller, the REIT sellers, or is it just across the board?
Across the board. I mean, we had, it's public information, we were selling an awful lot for a REIT that was winding down. And that constituted a lot of the volume, which had been great. But actually, I think we're going to move on to it now we've got a real diverse amount of seller profiles in our catalogue, and always have and always will. However, I think more than ever before, they all had one thing in common, which was the impact on interest rates on their businesses as a consequence need to sell. So that goes down from housing associations, councils, banks, receivers, all of which, and property companies where they were having to refi and therefore sell a few assets to bring their LTVs back up again. So they all had, almost all of them had that in common, that interest rates had an impact on their business and as a consequence needed to sell.
And Housing Association funding was on the prime time really full this morning. It's quite a challenge still, isn't it?
It is. And
therefore they're selling as well, I guess.
Absolutely. And that's why they're probably one of the prime ones whereby they do have debt and the cost of borrowing has gone up. As a consequence, they've got to raise more capital. So we are seeing an increase in housing associations. It's well publicised that councils have had some issues. Lots of them have had issues and, again, need to raise capital. So when they need to do that in a fair, transparent and quick way in timely fashion, then they come to us.
Well, briefly, to cover the commercial side, it all feels quite flat out there. But actually, when you start analysing the numbers, we've sold the same value, sort of 460 million as we did the year before. Our big change has been really the type of sellers and the lot size. Our average lot size is nearly 900,000 because we've sold so many, really, for us, very big lots. I mean, we started the year with £7.5 million in Chingford.
Why? Why is it a big lot size? Why is that?
It's gone up because I think probably the wider market's quite hard. Transaction times are taking a long time. Reasons not to buy have increased. And we work with a buyer who's happy to look through those questions, and I'll come on to it later, the valuer's perspective, but they don't all worry about the valuers. Our buyers want to buy the asset and get the income. So you look at Pall Mall in July, £10.5 million, £10.8 million on Pall Mall. The liquidators needed that sold. They couldn't sell it private treaty. We got the auction hammer to work and it sold at 10.8 million.
And was not necessarily specific to that sale, because we've spoken about it before, but on the larger lots where they've been stalling private treaty or it's taken too long, is there a trend in terms of you've brought in new buyers that have bought it, or you've just beaten across the line, the auction beating stick of existing buyers?
Well, I think it's a good point. It's a mixture. What I would say, talking to people who want to sell that sort of thing, is we will bring new buyers to the mix. We will add more competitive tension. I think on balance, we bring new buyers to the scenario. The last hotel we sold in Aberdeen, been on the market for 6 months. We sold that to an auction buyer, £3.5 million, as I was standing in the shed at Gloucester, actually, on the Friday night. We exchanged contracts, but that was someone who hadn't considered buying it and looked straight through any reasons not to. Just right, I want that income. I want 100-year income. I want to pay 7%.
So it's that depth of national buyers that will...
we bring new parties to it. So before we go into too much detail, Susie, what's happening? Law seems very busy in commercial.
Yep.
Are they multiple lenders? What sort of lenders you acting for?
Yeah,
I assume it's mostly lending work.
It is mostly lending work, and it's still the major high street banks, the private banks, the challenger banks. What we're noticing, though, is borrowers are being a lot more picky and they're less loyal to their existing lenders, so they are moving around a bit more. Where historically banks might have asked us to revalue every year or every 2 years, borrowers are now looking at getting preferential rates at different banks.
How long are the rates lasting? There was a day when it was 5 years.
We're seeing 1 to 2 years now.
Loyalty is
is
not encouraging loyalty.
Yeah, exactly that.
Because that's what's being offered by the lenders, or because preference from the borrower?
It's what's being offered and concerns over values. Certainly 2 to 3 years ago, there's a lot of concern around the retail market. So banks were asking for revaluations just to check where they were on their LTV. Now retail has come out of the doldrums and it's really beginning to shine again.
That's what we like to hear, positivity.
2 years, is that really common then? So that almost all the time?
Not all the time, but certainly the big high street banks are looking at us to revalue portfolios at least once a year, possibly every 2 years.
But then they're offering terms greater than 1 to 2
They
years.
are, yes.
Right, yeah.
Oh, okay, That's good. Because some of this refinance can take 6-12 months, can't it?
Yeah.
As I hear from our lot.
It's very slow still, and I think that's a bit of a hangover of COVID as well.
And on that point, on the commercial sector for portfolios and for larger lot sizes, what terms are being offered?
Typically 3 to 5 years.
3 to 5 years.
Yeah.
Interesting. I would assume, and also there's different buyer profiles out there, that commercial investors want to know their position for as long as possible in terms of what their net is going to be.
Yeah. I think talking to our client base and the buyer base, they're not very highly geared, but they will have a slug of quite longer term debt as they can get, ideally across the portfolio. Now, that's not very common anymore, but if you've got a good relationship. But I suppose if people are becoming less loyal, those facilities are going to become less common.
Correct.
And in terms of people say high street banks have moved away, are they back into commercial?
They are, yeah, and certainly back into retail that we're seeing. I mean, I have a particular bias. I value more retail property than anything else, but high street banks are lending. Retail parades, the essential retailing is back in the market.
And you were wonderfully optimistic just then for Valuer, which is a strange concept. What makes you be so positive about retail out the doldrums? Great quote, but talk me through it. What's giving you reason to say that?
Well, I think rents have been rebased now and everyone's a lot more sensible. And certainly on retail parades, we're seeing small elements of rental growth again. So we are beginning to see values slowly increase.
And Susie, in the, obviously, meat and drink, the auction room is a sort of 35 to 75 grand rent for a high street shop. Is it that sector, or is it the 100 to 200,000 pound?
No, it's certainly in the smaller sector. Certainly in the convenience retailing, the local retailing. Certainly the 20 to 50,000 pounds rent roll.
There's 2,000 high streets in the country. Does that apply to more than 60% of the high streets?
Ooh, that's a question. We're certainly seeing more demand than we ever have for the local retailing. I couldn't put 60% or above on that, but more demand, slight increases in rents trickling through when it all adds to increased values.
Yeah, I would agree with you. I totally, and that's what our clients are saying.
Any difference in what terms the tenants are being offered or accepting in terms of how long they take occupation for?
Typically 5 years with a 3-year break, but some are even shorter. Some are 3 years with a 1-year break.
But that's better than it was a year or two ago.
It was, yeah. And we're seeing less void periods and less fines.
And the gap between prime and secondary and tertiary, is that getting a bit closer? Because it tends to widen when things get challenging in my view.
Yeah, I think, well, if we looked at 12 months ago, take the example of Oxford Street. Oxford Street was on its knees, Oxford Street in central London, and now we're beginning to see a resurgence there, slowly but surely again. Some would consider that to be the prime area.
In what sense, though, on Oxford Street, when you say because there was no uptake at all and the more vacant units coming along, and that's changing now?
That's changing.
And how's that changing? Who's wanting to take up occupation?
Well, we're seeing IKEA are taking the old Topshop store. Gradually, we're getting better quality tenants back into Oxford Street, and it's attracting the tourists and the shoppers in. So it's just creating a better environment all round.
And getting rid of those American sweet shops.
Yes.
I mean, it's really, this is what the chat all 18 months, 2 years ago, the American sweet shops, no one quite knew what they were. But certainly, Allsop's offices just off Oxford Street, if you go down there at lunchtime, there's a lot more people who've got shopping bags in their hands.
Yeah. Yep, absolutely.
Hey, let's hope that affects retail parades all across the country. So good. In terms of looking back at the auctions, Richard, buyers, I mean, any trends? Is it just opportunistic or...
I'm always wary of trends because whilst that's an awful lot of property sold in a year, ours is spread so, as yours is, across the country. So it's hard to pick up particular trends. But I would say so I've been doing this over 20 years, I've seen more small private investors than ever before. And I suppose to some degree it's dictated by what the sellers are selling.
Yep.
In terms of what buyers will come out, I suppose its logic would suggest. But we've sold a lot more in the regions, as I mentioned earlier on, smaller lot sizes in huge volumes, and that has brought out buyers that we've not dealt with before who might be spending 150 grand on a house or 250 on a parade or some flats. And we can measure that by, we've had him on it before, Jim, in terms of how many AML checks we've had to do. Yeah. That boring you all again, but we AML check all the bidders, not just the buyer.
Yeah, we won't put you through the AML process again.
But we did last year, I think Jim said it was something like 12,500 AML checks.
Wow.
Which is ridiculous. But the point being is they're all new entities, all new people, because those that we sold to before have to go.
Yeah, that's the whole point. 12,000, they are new buyers because the AML lasts 3 years.
Yeah.
In the commercial side, I mean, we did a check in December and 64% of the buyers were new. I mean, that's just extraordinary. So there is a bit of chat about people being driven away from what they used to call buy-to-let. But the regulations, people say, oh, it's so hard on EPC and...
Do you know what? I'm going to garble a response to this because ultimately we just don't know which way it's going in Resi. It was a really difficult past couple of years for the wider economy and everybody out there, and our market grew. And don't get me wrong, there were certainly times, beginning of last year, back end of the year before, where the buyer pools were thin. We're still selling, but it was thin. You might have one or two bidders or something where traditionally you'd like to have 4, 5, 6, 7, 8. So the competitive tension wasn't as strong. That seems to have changed back end of last year. How this year will pan out, I know you want to move on to that later. I think just before Christmas when we did a podcast, I was talking about general elections, government reform, America, Trump, all those things. And all that has an impact on consumer confidence and general confidence in the market. So that does have an impact on how our buyers do behave to a degree. But the things that were going to drive our market or affect our market the most will be what happens to interest rates for all the reasons that we've been talking about and that are obvious. And the second one is rental reform. There's been a lot of talk about the government, not rent capping, but controlling rents a little bit more and controlling the private rented sector a lot more. And how that plays out is likely to have more of an impact than anything else in our market.
Hasn't popped up yet, has it?
No.
And I mean, if you go to Scotland, it's very, very controlling. I mean, stamp duty rate higher, rent controls higher. Hasn't necessarily worked out for some of the people.
No, and if you talk to Scottish private investors, it had a really negative impact.
Yeah, so hopefully the government, goodness me, they might even be listening.
I think more than anything though, but resi buyers, like any buyers, any investor in property, resi or commercial, you want clarity, and that's why we had issues, last year and the year before, where people want to know the direction of travel so they can make some informed decisions as to what to do. And that element of uncertainty surrounding rental reform, EPC regulations, and what people are going to have to do to their properties doesn't help. Once you get some clarity on it, you can price it in, and the market, as you said, will rebase, readjust, and the market can take off again. What we can't get away from is the fact that there's been a real lack of development and planning and all various other things within our market with a growing population and a growing need for housing.
Yeah, I mean, this is Richard's hobby horse, isn't it?
It is, and that will underpin our
houses.
market. It might mean that we have peaks and troughs as people wait and see, sit on their hands and see what's coming down the line, but that underpins our market, whether it's rental or whether it's sale for occupation. Yeah. That underpins our market. It's supply and demand, simple as that.
Yeah. I mean, Tony's registered buyers. I mean, I've done a bit more analysis, and the Outlook document is being published shortly. When you look at the number of buyers registered on lots, I mean, for us, 10 buyers registered on a lot is a lot. At the beginning of the year, we had 10 people registered on a £3.5 million lot in Stoke Poges, and it was a decent lot size, so we all got them to send us 50,000 each. A dozen people send us £50,000 on this long let lease to Nuffield Health. I mean, it was within 10 miles of Heathrow. It was a nice long lease. It was CPI increases. But that was a real statement at the beginning of the year where people were saying, actually, do you know what? I just want to harness this. It's a counter. CPI increases every year. It's a counter to any change in interest rates, and it's a nice asset. It sold in the end at 5.7 mil. And I think one of the other lots that we had, an aspect to the sellers, there's a lot of trading happening, and trade drives trade. And you can, when the phones aren't ringing necessarily, in the course of the year, I'd say it was quite quiet. About 15% of what we sold actually had recently been bought. So some of that was portfolios, some of that was individual assets. If the canny buyers are out there spotting an opportunity, and I think I will come into this later on, how will I spend 10 million quid? Don't be put off. There are some sellers that actually have thought last year, well, I'll take a price, whether it be a portfolio or individual sale, and then we've got a much better price in auction. That is because our market is quite wise, quite perceptive. But if the portfolio of 16 lots that we had in the middle of the year had all been, I mean, it was sold as a portfolio because the receivers wanted one sale, one contract, that's fine. We had over 100 people. Obviously, the initial seller got what they wanted, was a contract price. And we exposed it to the retail buyer.
I'm conscious we probably want to move on to what we think might happen next year, because that'll be interesting in itself. But did you notice trends last year? And I asked Susie a minute ago about the gap between prime, secondary, tertiary. Because what you've described to me is the same as what we witnessed. There'll be certain lots, certain property types and certain things throughout the last year where we had 10, 15, 20 buyers on it. But then you'd have other lots whereby there was 1, 2, 3 bidders on it, and it was really tough getting it across the line. Aside from pricing, did you notice trends in sectors, in areas, in locations where that was apparent?
I think interestingly, I mean, Susie, you talked about retail bottoming out, and I would say you're right. But give us a town centre, former M&S, which to try and get out of, and sometimes there's no yield high enough. So I think the differential in yields is enormous. I think there is a core. Just taking the retail sector, a core is a 7, 8, 9% type of touch, and that's quite solid. Yep. But then when it gets to questionable length of lease, difficult building, asbestos, EPCs, there's sometimes no yield high enough. And I think obviously we can find those buyers, and we have, but the differential in yield is as high as has ever been this year, because some of them, some assets are still a slight leap of faith.
So it's that famous old phrase of flight to quality.
Come back to it, don't we?
Yeah.
But I think that some of the towns, where they're just questions, too many questions, and it's perhaps just too many questions, the buyers do tend to run, and that's when I think 20% yields, there's some money to be had there, some money to be made in that sector.
So there's an opportunity out there, there's opportunities out there all the time, but for buyers that value add, someone's got their hands dirty.
No question.
Yeah,
no question.
And Susie, looking at the amount you guys have valued last year, do you see, aside from pricing, do you see that as well? And if so, what are you seeing? Is it location? Is it sector? What's hot and what's not?
I am personally a bit concerned about the office market. I think the out of central London, if you've got a secondary office, certainly on a business park, not everyone's back to the office still now. Offices need to be refurbished every 3 to 5 years, and that's getting expensive. Yeah. Refurb rates are looking at about £200 a foot.
Compared to what?
Compared to, well, you're building...
5 years ago?
5 years ago, maybe 80 to 100. And if your building's only worth £150 a foot, what do you do with it? What do you do with it? So I think we are a little bit concerned about the office market.
We've seen build costs since COVID. Since COVID, build costs in residential or anywhere have skyrocketed. And they may have settled a little bit, but they've settled at a high level, which helps. But I suppose it will come to a point, won't it, for a landlord, is that what's the alternative? Because the previous alternative was, we'll convert to resi, but those build costs are just as high, if not higher.
Absolutely that.
So it doesn't really
It's quite a bit of a cleft stick there, you know which way to go. So, secondary Manchester is a challenge, or secondary Leeds. But so in London, you've got this ridiculous concept of West End is, offices are £2,000-3,000 a foot in the best spot. You can't get £250 a foot if they're off pitch. Is that replicated throughout the towns? I suppose you're saying the business spots particularly. Particularly
where there's no alternative use or, as you said, any conversion there. What do you do with it? There might be some medical use, there might be a leisure use, but that's not going to work in every area and every location.
Do you think the planners may help that by allowing alternative use, or are some of these offices just offices?
I would hope there would be some planning angle on it, but some of these offices, certainly on business park locations, they are just offices.
That's the trouble when you've got the big business parks, and I've seen them before 10 years ago where actually some of them were starting to be converted into resi, but there were still retail park, office park parts to it, so it wasn't a very
mean, 'cause
attractive,
you were there at the
enticing
beginning of
residential.
PD, you did a lot of it. didn't
Yeah, and they were selling because the market was flying, so there was appetite to do it, and that was the first thing to sort of drop off, obviously. So I suppose when you get not isolated, but a smaller office park or a single big office near a town, that's
It's
the
a
low
long way
hanging
from
fruit
a car, a long
PD.
way from a swimming pool, it's a
It
long way
is,
from
yeah.
shops. It's just on its own. It's quite
Yeah.
hard, isn't it?
Yeah.
But so the centre of towns, I mean, there are funds being created. I mean, Lloyds Bank this morning, we're getting all our workers back to the office. So that should support the better of the London and the regional towns and cities.
Absolutely that. And tenants want good quality office space. There is that demand now that tenants want a gym, they want a cafe, they want services for their employees. So the best offices will do very well.
Yeah.
It's the ones that aren't quite up to scratch yet that I think are going to have some money spent on them, bring them back up to a good enough standard.
And that's going to knock the values, isn't it?
It will.
So let's look ahead to 2025. And we've got some stats and we're publishing the Outlook document from both sectors. So you have a trawl through those if you'd like to. Susie, if you had 10 million quid to invest this year in your sector, come on, and what would you do with it to make some money?
That's a question. I think I would look at retail warehousing. It's easy to asset manage compared to a lot of the other asset classes. They're generally let on long leases. You've got RPI linked reviews in the lease.
Good covenants.
Good covenant strength.
It's quite dull, isn't it?
It is a bit dull, but it's a sector that's booming.
And what sort of rental growth have you seen over 2 or 3 years?
Oh, wow.
Yes, I'm putting you on the spot. There it is.
5-10%, definitely.
Really?
And it's more essential retailers that are going into these retail warehouse parks. A lot of the food retailers are going in now, and they're prepared to pay the bigger rents.
Yeah. And so and your 10 million quid doesn't get you much of a retail park, but it gets you a couple of smaller units, doesn't it?
It would do. Yeah, it would do.
Okay. Rich, £10 million in cash. How are you going to make it work in your market in 2025?
I can't just take the cash.
This is not
That's
traitors. Sorry.
That's a shame. I'd spent it already. What would I do? I mean, the lot sizes that we deal with, we're talking specifically to auction, it's
a lot of lots.
It's a lot of lots, yeah. Which is no bad thing, spreading risk, eggs in one basket, and all that sort of stuff. But I think I would put together a portfolio of higher end and better quality HMOs in good locations. They're very popular. If they're run properly and compliant and all the rest of it, they are good investments with good income
HMO,
streams.
you mean
House of
minimum
multiple-
five units?
Yeah, that's right.
House of multiple occupation.
Yeah, which we've sold an awful lot of this year. And I think there is a real demand for that. And rents, as we've talked about before we came in here, resi rents across the board have been skyrocketing.
And do you think
so? They're pretty safe.
without people can research it, but is that a national phenomenon? Resi rents improving, or is it just the big five cities?
No, it's all across the country. All across the country, rents have been increasing across resi. There's very few places where it's not increased over the past 2 years.
And Anthony
past
Hart,
year.
12 months ago, was saying that student sectors rents are improving by 10% per annum, and resi is the same.
Resi is the same. It's been so well publicised, and it is a problem. And that goes back to what I said before. It's that lack of stock, and it's driving rents up to levels that are unaffordable for a lot of people. And there's more demand in the entry to housing, if you like, for people that can only afford to rent single rooms, or for those who have lifestyle changes and actually only want to take a room 2 or 3 days a week, that kind of stuff. So that sector's changed an awful lot. And for those experienced investors, they probably know, but HMOs used to be frowned upon. There are a lot of really good quality HMOs out there. There's a lot of bad ones, but there's a lot of really good quality HMOs out there, which can be, if run properly, can be very lucrative, high yielding, depending on how you manage them all.
Just get your head around the legislation.
Legislation,
Just
yeah,
understand
and compliance is critical in those sorts of things, and having knowledge of the area and the demand there and getting them well run and managed is key. But I think it's an attractive sector.
Yeah, it's all open book stuff, just understand it. Well, in the commercial sector, £10 million, I would be classically conservative and split it 3 ways probably. I'd just buy I think a Farm Foods or a Tesco at 7.5% for a 20-year lease, or 7.5% 20-year lease, is too cheap for the market. That's for the market price. So I think in 5 years' time it'll be worth more, and particularly, as you say, with those increases, Susie, on a 5-year basis. So with a single letting of 15 to 20 years, you can get some debt on it, because I'll come to you for that, because all these retail banks are lending to improve your return on the cash. I would definitely go for a high yield. I would try and find a year where we're talking 20%, because if you stop worrying about the ifs, stop worrying about the reasons not to buy something. If you're listening to this podcast, you are an investor that likes to take control. You are really good at aspect of your market, of our market. So be brave, because every seller has a different motivation. And just because the lease has got below 5 years, got below 2 years, for that particular fund, they will have to sell it. But it doesn't mean that it's not a big lump of real estate in a decent town that you can do something with. Yes, it requires a project team. Yes, it requires expertise. But that's, again, how you make money. I think the other thing I would come back to, without actually, my third would be jumping on a bit of the mixed use and residential. I think London, good cities, because apparently the rents in New York are 50% more than they are in London. So, you say affordability, and I question that. It does seem, I've got some of my family in London and the rents are very high. But if New York is trading 50% more than London rents, that does show that people will pay it.
A lot of people will say, and have said for a number of years, 3 years or so, that London in parts is undervalued in resi. And a lot of that has probably been due to sanctions and Russia and all the rest of it, whereby the real super prime London is underpinned by foreign investment that hasn't been happening during COVID and during the Ukraine war and various other things. So there are some out there that have been saying for a long, long time, they see London being, prime London and sort of secondary London being undervalued.
We're a big force. We shouldn't shy away just because things are a bit down at the moment.
How do you see this calendar year panning out in comparison to last year in terms of sellers' profiles? Will that change? Buyer profiles, will that change? Will there be more volume, less volume, high value lots? What gut feel and how?
I think we have a core of sellers, so the Tesco's, the Farm Foods, the Heron Foods, the leaseback as clients who always need to release capital, and they will be popular and they will take the market rate for those lots. I think the funds, 15% of the sellers are funds. They're always a moment in time in their portfolio. They have to access the retail investor that we do. I think there'll be more churn. I think people are resigning themselves to rents. Yields have got to a point where sometimes people just want to move on, and because they think there's opportunity somewhere else. I don't think there'll be a lot of change. I think at the end of the year, yields will start to improve because the truth is a new government and a new budget, it's all hanging a shadow over us, and we take as human beings a long time to accept and understand and work with a new regime and new policies. The budget was a bit tougher than we all thought. Yes, it's got some implications, and we talked about interest rates and inflation. We just have to work with it. But I think we're inherently quite slow at adapting. Therefore, the moment is a chance to buy well. And if you ask Susie to value something, there are lots of ifs in a valuation, lots of reasons you have to take 5% off the price or 10% off the price. Our investors see those ifs, and it doesn't matter to them as much. Our investors are not funds, and they can buy off these funds at sensible prices. The funds want to sell. I'm not saying they're discounted, but it is an opportunity. There is quite a lot of sellers will have to sell for solid reasons. And I think it'll be a year where clearly the flight to quality, Richard, we've seen that through the last 20 years, always sell great stock to a plethora of people. But there'll be bits in the middle where people will make good money out of it over a 5-year period. I don't think you're going to have too much wham bam, thank you ma'am trading in a 3-month period, but our investors aren't typically like that.
A better year than last year?
I think so. I think at the end of it, I think get through the next 6 months, we'll all accept to stop banging on about the budget. Hopefully, the Gaza crisis is drawing to an end. Can Trump really deliver a ceasefire in Russia and Ukraine? I don't know. All this stuff will be clear in 6 months, and it'll be behind us. And obviously, we hope it does. And I think at the end of the year, we'll be more optimistic. We live in a big, powerful country.
And same question to you. Susie, what do you see this year playing out like in comparison to last year? Much of the same or slightly better?
I fundamentally agree with George. I think we are in a bit of a lull and not a lot is changing fast. So I think it'll be more of the same in terms of valuation this year. And I hope for a better end of the year. Things will be a bit more optimistic.
Yeah.
And same to you.
Yeah, I do. I've been surprised at how robust the residential investment market or the auction market has been since COVID, if I'm honest with you, because we've had so much thrown at us, whether it's just reform, whether it is pandemic, whether it is wars, build costs going through the roof, all the things that have been thrown at that market, because there's such a strong depth of buy and there is a supply and demand issue there, generally. So I'd like to think that the next 12 months will be slightly better than the last 12 months, pure and simply because interest rates have come down since the beginning of last year. So that should encourage people more. But you never know. I think it'll be an up and down year. I think when there's predictions of interest rates coming down, assuming they do, there'll be a reason to sit on your hands a little bit. And some people love a reason to sit on their hands, and I get that. So if there's an unpredictability as to when that's going to happen, I think you'll get mini peaks and troughs throughout the year in terms of supply and demand and appetite. But you smooth that over a 12-month period, the metrics are there to suggest that it should be a more encouraging atmosphere to invest money and buy property. And whilst other markets and investments are more turbulent, there is that, let's go to property bricks and mortar, we understand it.
Yeah, and with £10 million of HMOs, mate, you'll be very busy. Thank you very much, everybody. I hope that's an interesting insight into what the Allsop team think will happen this year. Any feedback, always welcome. George.walker@allsop.co.uk, richard.adamson@allsop.uk, and Susannah.Summers@allsop.co.uk. Look at the web if you need further definition on that. But thank you for your time, and we look forward to the next one.